Hey guys, it's CK here. So some of you might know me as the Alibaba guy because I've been covering the stock for close to 2 years now. And even after this 2-year-long ordeal, Alibaba is still down 70% from its peak, with concerns around tech regulation, the US-China tension, and even a spy balloon. Who would have thought? So with a broken heart and 2 years of headache, I'll do my best to synthesize all the important things that I think an investor should know before investing into Alibaba. Now, let's explore some of the motivation factors that got investors interested in the first place into investing into a Chinese company like Alibaba. I'll start. So before I actually bought into the stock, I've already known their flagship app, which is called Taobao. So I have friends and families who are avid users of the platform. And the term Taobao has been synonymous with buying anything cheap. And I mean anything. So as long as you have the money, I'm sure there are Chinese merchants out there who are willing to accede any of your requests. Of course, less most of the illegal things out there. Anyway, I just had this fuzzy impression of Alibaba being this humongous e-commerce behemoth that is probably unrivaled, especially so if you want to get your hands on dirt cheap products. So I then went on to research about the company, and the more I studied the company, the more I liked the business and the execution over the last 2 decades. And the business was essentially priced at a decent valuation. I was essentially sold. However, when speaking with other Alibaba investors, there were many people with vastly different motivations. Some of them include, oh, I saw Charlie Munger bought into it. And Charlie Munger, being a huge value investor in the entire investing space, it probably is a huge value signal. That's why I followed. Some said that they bought into Baba because it felt like a mini ETF, an exchange-traded fund, essentially a proxy towards getting exposure to the Chinese market because it was the biggest e-commerce platform out there. There were also some that said that they wanted to capitalize on the fear around tech regulations and the tech crackdown back in China. Whatever it is, Alibaba remains as one of the most beaten down large cap stocks out there, experiencing a more than 80% fall from peak to trough. So with an 80% drawdown, that's more than $600 billion worth of capital that were wiped out from the face of the earth. So what happened? Yes, it was one man's decision. Okay, maybe not so dramatic, but Alibaba was essentially caught up in this transition phase where Chinese regulators were relooking into the entire tech space around issues such as anti-competition, data privacy, algorithm recommendation, and whenever there was an announcement about a ban or a fine around many of these tech companies, Alibaba's share price followed suit. And by follow suit, it just went southwards. Side note, this is actually not the first time the Chinese regulators come together to coordinate a crackdown on a specific industry. Technology stocks just so happens to be next in line. So I love this representation from Lilian on Twitter. China innovates, then regulates. Europe regulate, then not innovate. And the US innovate and then not regulate. So do leave in the comment section down below on whether you agree to this observation or not. So let's address the elephant in the room. Is it still quote-unquote safe to invest in Alibaba today, or any Chinese companies for that matter? So I can only say this. It is a question that you have to find an answer for yourself. I don't have a direct answer for you. So when investing in a different geographic region, you are essentially playing a completely different game. You must understand the rules of this new game. And similarly, for investing in China, they adopt a culture of being quick and efficient. But the trade-off for that lies in the dynamism and the constant evolution of the business environment, which might turn many investors off. And evidently, over this 2-year-long ordeal, many investors, at least for people that once tried to pick stocks in the Chinese equity space, were burnt and scarred. So that is a huge caveat that I wish to square away first before talking about anything company specific. So if you're uncomfortable investing in a foreign region, then it doesn't even matter if it's the best company in the world. You can't even sleep well at night. I would suggest that you stay away from many of these Chinese stocks by and large. So I found the answer to this question for myself, and you need to find it for yourself too. So with that in mind, let's get down to business. So why should anyone be interested in investing into Alibaba in the first place? Personally, I have 3 core investment theses: execution track record, growth re-acceleration, and valuations today. Firstly, let's talk about execution track record. So the team over at Alibaba had a splendid run. So they are currently ranked first in e-commerce in terms of market share, first in cloud computing, first in digital payments back in China. So what more can you ask for? Particularly in a highly competitive environment such as China, being able to claim and retain your market dominance is a feat that is worth celebrating for. And we are talking about multiple industries here, by the way. So Alibaba also had an impeccable track record of spawning many other unicorns under their belt, including Ant Financials and Cainiao. So Ant Financials and Cainiao are currently ranked 2nd and 6th leading unicorns in China as of first half of 2022. So you can call them lucky for winning it big with their e-commerce business, but I suspect that they might actually have a special formula to keep winning in the different industries that they choose to enter. Secondly, Alibaba was also largely plagued by the tech crackdown and the zero COVID policy that was abolished just last year. So I believe that both headwinds had an incredibly detrimental impact to Alibaba's core business and subsequently its business performance, which caused many investors to actually sell down the stock when they see declining year-on-year revenue growth rates and significant deceleration of growth in specific industries like AliCloud. However, I believe that both the impact from the crackdown and the COVID stance will be transitory in nature. Evidently, we are observing signs of recovery in real time today, coupled with the hints from Chinese officials that the worst might be over for some of these tech companies. Fundamentally, I believe once the economy is back on track, it should reflect quite optimistically on the earnings and bottom line of Alibaba's core business again. Thirdly, I believe that valuations remain largely attractive around Alibaba. So when compared to its IPO price back in 2014, Alibaba's share price has largely stayed in the same range, while your other companies has went ahead to 5x or 10x within the same time period. In the meantime, however, Alibaba has gone on to 10x their revenue, 4x their operating income, and 5x their cash flow, yet valuations have remained largely stagnant. So were valuations too overvalued 9 years back, or are valuations too undervalued today? I'll let you make your own decision. Not to mention, Alibaba currently has $58 billion USD on their balance sheet. It's worth around $20 per share today. Of course, don't forget about their debt position, which is largely manageable. So I'm just putting more emphasis on the financial fortitude of this company, and I don't expect them to go bankrupt anytime soon. So I'm just going to flash a quick snapshot of some of the common financial metrics used to evaluate companies. And you tell me whether you think they're attractive or not. An EV to EBITDA ratio of 7.24, a price to free cash flow of 8.72, and a forward price to earnings of 9 times. I believe even the biggest bears of Alibaba today wouldn't attack Alibaba because of its valuations, but instead with arguments such as geopolitical risk, growth and margins, and the most common one, the China discount. Furthermore, I believe that given the current relative valuation of Chinese companies compared to their US counterparts, they do seem to offer much more value after all. So don't hear it from me, hear it from Charlie Munger himself.
Well, those are good questions, and there's no question about the fact that the government of China has worried the investors from the United States who invest in China more in recent months and years than he did in earlier periods. So there's been some tension, and it's affected the prices of some of the Chinese stocks, particularly internet stocks. Just in the last day or two, the Chinese leader has sort of reversed course on that and said he went too far and he's going to pull way back and so on and so on. So we're having some hopeful signs. But yes, there are more difficulties of dealing with the regime in China than there are in the United States. And it's different, it's a long way away, and they've got their own culture and their own loyalties and so on and so on. And the reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion, and everybody is more worried about China now than they were 2 or 3 years ago. So that's just the way it is.
That said, you must keep in mind there are no perfect investments in this world. All of them run their own set of risks, Alibaba included. So one of the main concerns around Alibaba today as an investment is the high frequency of noise. I mean developments around the stock, which made it incredibly volatile. If you just look at the share price itself, I don't think you need someone to explain it to you. So as Alibaba was essentially the quote-unquote poster child of the entire tech crackdown, they are probably seen as the proxy to investing in China, and many investors actually trade around them. So on a good day, there are positive developments around the potential revival of an IPO, and it sends the stock to the moon. while on the bad day, you see that there is a spy balloon that appeared in the United States, and the stock just tumbles down for 5%. This is exactly the type of volatility you have to handle as an Alibaba investor. But I would like to remind investors again that when you put money in the stock market, you are backing a specific company behind the stock ticker, and not just numbers and digits on your computer screen. On a fundamental level, there is actually a convincing argument that justifies the collapse of Alibaba's share price. Growth is slowing down, margins are deteriorating exponentially, and they seem to be losing grip around their competitors and their market share. So slicing through the noise of geopolitics, investors should be more concerned about how Alibaba is putting up the fight to maintain their market share and their economic moat over competitors. Currently, Alibaba's management team seems to be squarely focused on managing their cost structure and rewarding shareholders by unlocking value and buying back their shares, and even a potential breaking up of the business to unlock more shareholders' value. So in fact, they have also confirmed that they are looking towards IPOing both Cainiao, which is the logistics business, and Fresh Hippo, which is the retail business, while also distributing AliCloud as stock dividends to shareholders in the upcoming 6 to 18 months. So long-time Baba investors like myself will continue to monitor the dynamic situation around how their competitors are faring in e-commerce and cloud and in logistics to ensure that Baba continues to execute and deliver. Lastly, you probably want to read up a little more about this monster called the VIE structure. I'll leave the link to an article from Crane Shares in the description box down below. So the article revolves around busting the myths of VIE, but just to let you know, you are investing into equities with a special arrangement, and welcome to China. So all in all, I still believe that Alibaba is an attractive opportunity from a risk-reward perspective, especially with the current position to capitalize on the expected recovery of the Chinese economy. However, that said, I would like to caution potential investors of the inherent risks when investing in companies in a foreign jurisdiction, which was addressed in the earlier part of this video. Ultimately, you have to be comfortable with the uncertainties that come together with investing in China. So one way of mitigating such a risk would be to size the position appropriately on a portfolio level. So for investors that are primarily interested in gaining China exposure, there are other alternatives available, such as investing into a China-focused ETF or even a sectorial-focused ETF, which would further diversify the risk across a basket of Chinese stocks, rather than picking one. With that, I hope that this video is a great addition to your research before investing into Alibaba, and this is CK from Piranha Profits. Until next time, keep winning.